Hello everyone, I hope you guys are doing well and studies going in full swing. In today's video, we are going to discuss about a largely ignored topic by the students, Ind AS 101 on first time adoption. Now, this is a topic which usually comes in your preparation somewhere at the end of your preparations. By the time you're already kind of pressurized, so a lot of time students unfortunately take the decision of leaving it and creating unnecessary uncertainty. So over here we will try to record a short, comprehensive and a completely exhaustive video with all the relevant concepts and the important questions as well. So in case you're short in time, just refer this video, have a broad understanding, get your much needed confidence and complete the entire FR course including Ind AS 101. So what is this standard all about? Well, this is a standard on first time adoption of Ind AS. So this is applicable only to those companies which are adopting Ind AS in their first financial statements for the first time. Now, you must have studied the applicability and roadmap where Ind AS is applicable to companies which are listed as well as private companies whose net worth is greater than or equal to 250 crores. So if you are a company, let us say you are in the year 24-25 and you are get listed, or you are a company whose net worth crosses the 250 crore limit, or your group company crosses that limit, in which case Ind AS becomes applicable to you, and that is the point where Ind AS 101 will apply. So this is a standard which will be applicable only one time in the company's lifetime, that is when it moves into Ind AS for the first time. So what are first Ind AS financial statements? Now, first Ind AS financial statements refer to statements where an entity, the management, gives an unreserved an explicit statement of compliance with Ind AS in the notes. Like in Ind AS 1, you have to give that statement for the first time and every time when you comply with Ind AS. So over here for the first year, let us say your last audited balance sheet was 31st March 24. So for the year 24-25, Ind AS becomes applicable to you for the first time. So in the 24-25 financial statements, you will give a note for an unrestricted unreserved statement of compliance that is called as the first Ind AS financial statements. Next, we go to the important term of transition date. So when do you transition to Ind AS? So let us say in our example 24-25 was the first Ind AS financial statement. However, it is mandatory to show at least one previous year, that is the year 23-24. So the previous year was actually prepared as per previous GAAP, let us say AS, and hence you need to restate it to make it comparable with Ind AS, and hence the transition date will be the first day of the earliest comparative period. So assuming you are giving a 1 year comparative, then the first day of the comparative period. So 1st April 23 over here would be the transition date. Next is understanding what is previous GAAP. Previous GAAP is the accounting framework that was used in India prior to Ind AS. So usually for most companies this would be the accounting standards framework, at least in India. Okay, next you go to the applicability of Ind AS 101. So let us say we assume that Ind AS 101 is applicable. So what will be the impact for this applicability? So over here, once Ind AS 101 becomes applicable, 4 things need to be done. First, items which were recognized as per previous GAAP and would not be recognized as per Ind AS need to be removed. Like proposed dividend, for example, which was proposed by the board, was shown as a liability under previous GAAP. Ind AS says you can show it only when it is approved in the general meeting. So you will have to de-recognize that. So you will de-recognize items not permitted by Ind AS. Second, you will recognize items which are required as per Ind AS. So for example, there were bills that were discounted or debtors which were factored and you had de-recognized them. But Ind AS 109 says that till the time the risk and reward is transferred, let's say for recourse factoring, you should not be de-recognizing them, in which case under Ind AS you will have to again recognize them back. So recognize items which are required to be recognized as per Ind AS, de-recognize those which were not required as per Ind AS. And so the question always arises that, okay, if I recognize an item, where will the second effect go? Well, typically, unless given otherwise, the second effect goes against other equity. If nothing is available, we will take it to retained earnings. But in certain other cases, you can take it into some other reserve like revaluation reserve, etc. Where appropriate, we will discuss that. But by and large, it goes to the retained earnings. So recognize, de-recognize. Third is reclassify. So under AS, you had nothing called as investment property. So everything was shown under PP, or preference share capital was shown, for example, in share capital. Under Ind AS, it needs to be shown in liabilities. Investment property needs to be separately shown. Here, you need to reclassify items as required as per Ind AS as on the transition date. So third is reclassification, and the fourth and the most important one is the remeasurement part, where you will have to remeasure items as per Ind AS principles. Remember, the policies that are followed as per previous GAAP or AS are going to be different as compared to the policies as per Ind AS. So the standard says you need to restate as per Ind AS, because now you are preparing Ind AS financials. Restatement usually is done as per a new policy as per Ind AS 8, which says that restatement should be done retrospectively. However, if you sit to retrospectively restate all the items as per Ind AS, maybe it will take one full financial year, and hence the transition may be very difficult, and hence the standard gives you a lot of relaxations, which is what this standard is all about. It says, for example, for items like PP, where you have to retrospectively restate as per Ind AS 16, they say, well, you know what, you can retrospectively restate if you want to, otherwise we will give you a choice to transition at something called as deemed cost. So what is meant by deemed cost? Deemed cost is nothing but a proxy, a substitute for the Ind AS number. Deemed cost may be the fair value as on the transition date, it may be the previous GAAP carrying value, or in certain cases you can even reset it to zero value. This is what you need to remember when you study Ind AS 101, that when I'm transitioning as on the transition date, what should be the deemed cost if it is required under Ind AS 101. However, Ind AS 101 does not give you deemed cost for every item. So something like a provision for site restoration, there is no deemed cost exemption, in which case you have to retrospectively restate as per Ind AS, and the second effect depends on a variety of things. So we will study that. So four things have to be done at the date of transition. You need to recognize items as required by Ind AS, derecognize items not required by Ind AS, reclassify items as per the appropriate heading in the Ind AS, and remeasure them as per Ind AS 101 principles, and that will take care of the applicability of Ind AS 101. Okay, now the standard gives you certain mandatory exemptions or optional exemptions. So you can see that there is a fairly detailed list of these mandatory exceptions or optional exemptions. Now from an exam perspective, you don't need to refer to each and every one of them. You should do the things which the institute has asked either in the study material, RTPs, MTPs, etc. So we will discuss in this video all the relevant transitions, every sum that is there in the institute study material or RTPs, MTPs, or which is there in the exams, can be covered within these exemptions. But if you want to go into further detail, which I think is not necessarily required, then you can go through the study material for all the list of optional exemptions, though I can say with a fair degree of confidence that if you kind of understand these 10 or 12 important points, it should more than suffice. So the important transitionary items, first pertaining to share-based payments. So if you look at items like ESOPs, now ESOPs as per Ind AS 102 have to be recognized at fair value. Fair value is to be determined using option pricing models like binomial, Black-Scholes, etc. However, if you go to the previous GAAP, there was a guidance note which allowed you to even record these ESOPs as per the intrinsic value method. That is, you look at the market price as on the grant date of the share, compare it with the exercise price, and that's it. You can even value it as per the intrinsic value on the grant date. Ind AS 102 does not permit that. So let us say your transition date is 1st April 2017. You had granted an option on 1st April 2015 with a vesting period of 3 years. So it will vest over 3 years, and then there's a 2-year exercise period. So on 1st April 15, prior to Ind AS, there was previous GAAP and you measured it at the intrinsic value. Based on that, in the year 15-16 as well as in the year 16-17, you have recognized your employee benefit expenses. Now on 1st April 17, the options are still unvested because there's still 1 more year remaining. The options are unvested and you are transitioning to Ind AS. So 101 says that for unvested options, we don't give you any relaxations. For unvested options, you have to retrospectively restate based on the fair value as per Ind AS 102 that you will have to determine, because there's still 1 more year remaining and hence the expense has to be recorded. So for unvested options, there is no relaxation or retrospective restatement as per the fair value of 102 is a must. However, for options which are vested prior to the transition date, there the standard gives you a relaxation. A doubt may arise that if the options are vested, then why do I even need to kind of see anything? Well, because it may not be exercised. For example, in the same case, if the grant date was 1st April 15, vesting period of 3 years, and the transition date was 1st April 2019, in which case 3 years have gone by 31st March 18, the options are vested. However, there's a 2-year exercise period that is continuing till 31st March 2020, and hence they have not yet been exercised, but there is an SBP reserve, stock option outstanding, still appearing in the balance sheet, which is recorded as per the intrinsic value. Here, Ind AS becomes a little lenient. They say that, well, you know what, the options are vested. There is going to be no future expense. In such a case, for vested options, we will allow you to either take the previous gap carrying value, that is based on the intrinsic value, or you can restate as per the fair value if you want to. So for ESOPs, long story short, for vested options as on the transition date, you have a choice to either continue with the previous gap carrying value or restate as per the fair value if available. And for other items like unvested options, you have to restate as per Ind AS. That is the first thing regarding ESOPs. Okay, second, you look at foreign exchange. Now within foreign exchange, there are two essential items. First, you have foreign currency translation reserve, FCTR, which as per the previous gap AS 11 was to be measured for non-integral branches or operations. Now under Ind AS, you might not have heard something called as non-integral. It is all based on functional currency, and hence if there was an FCTR balance as on the transition date, the standard says you can either restate it as per Ind AS 21 principles, or an easier way out would be you reset it to zero value, not previous gap carrying value, not fair value, you reset it to a zero value. So for FCTR as on the date of transition, you either restate as per Ind AS 21 or you reset to a zero balance as per Ind AS 101 principles. At this point, there is a recent amendment where there was an exception. It's not very important. We have even mentioned over here. The amendment over here is for companies where there is a parent and there is a subsidiary. Like a parent is, let us say, a regular entity, the subsidiary is a bank, and hence subsidiary did not follow Ind AS. They were under AS only. But parent, for the purpose of consolidation, would have restated the subsidiaries financials as per Ind AS and shown some FCTR. So for those subsidiaries, rarest of the rare case, for those subsidiaries which are transitioning to Ind AS after the parent, usually they transition together, but if they're transitioning after the parent, then the FCTR used by the parent at the time of consolidation can also be taken as a choice. So for these companies, they have three choices. Either you can retrospectively reset as per Ind AS 21, or they can reset to a zero balance, or they have a choice to take the FCTR that the parent had used for the purpose of its consolidation. A fairly tricky thing. If you understand, well and good, otherwise it's okay. You can just glance through and proceed. You need to know that FCTR has to be reset at zero balance. That is an important choice. Next, there is some foreign exchange gain or loss for items which were covered by para 46A of AS 11. Now what was there in para 46A of AS 11? Long-term loans which were taken. So a liability, ideally these are monetary items, and hence their foreign exchange gain or loss should have actually gone to the profit and loss account. However, as per the old AS 11, there was a choice that an entity could either take the foreign exchange gain or loss on these loans to the PNL, or it can take the option under para 46A, that is, it can for a general purpose loan, it can keep it in an account called as FCMITDA and amortize that over the period of the loan, or if it is a loan linked to a depreciable fixed asset, then capitalize it along with the depreciable fixed asset, and thereby the depreciation will automatically take care of that. Now if you remember this, well and good. If you don't, then don't worry. In any case, under Ind AS, that possibility is not there. Ind AS 21 says loan is a monetary item, foreign exchange gain or loss has to go to the PNL. So sir, why are we studying this now? Well, because at the point of transition, there is some transitionary relief given for entities who had taken the choice under para 46A to either take it into FCMITDA or fixed asset depending on the nature of the loan. So a brief background would be, at that time the government had said that this choice is irrevocable, and hence once you decide, you cannot go back. But now Ind AS 21 does not give you anything. So for example, your transition date is 1st April 2017. You took a 20-year loan on 1st April 2010. So 7 years have gone by. Let's say 13 years are remaining. Now you had taken the choice to capitalize the exchange differences into FCMITDA for a general loan or into fixed assets for a specific loan. Now from 2017 onwards, Ind AS does not permit that. You say that, well, you told me that this was an irrevocable choice. So the standard says, okay, we will stick to our words. For those entities who have taken the choice under para 46A, Then on the transition date, only for those entities, and that too only for loans which have already been taken and outstanding, we will allow you either to continue with the same policy as on the transition date or shift to Ind AS. But even these entities, if they take new loans, let's say in 2020 they take a new loan, then Ind AS 21 will only apply. It is only for existing loans that were taken in 2010 will the option to continue with the para 46A choice or switch to Ind AS 21 apply. However, for entities who had taken the loan in 2010 but they had said that I don't want any para 46A, I'm okay taking into the P&L account, then for those entities there's no choice. You will have to continue with the Ind AS 21 treatment only of taking it to P&L. You did not take the choice earlier. We will not give you the choice now. So long story short, foreign exchange gain or loss for existing loans where para 46A choice was taken, you are given two options. You either continue with previous gap or you adopt Ind AS 21. For new loans or loans where option 1 was taken earlier, then you have to adopt Ind AS 21 only. So this is a fairly specific case on a specific item pertaining to foreign exchange. Okay, third is one of the most common headings where you have PP, you have intangibles, you have investment in subsidiaries, associates or joint ventures in the SFS, all of these. The standards say that you can either retrospectively restate as per Ind AS or you can take the deemed cost, which can be the previous gap carrying value, that is the WDV in general, or the fair value. So if you are the type of a person who says that okay, I'm lazy enough, I don't want to retrospectively restate as per Ind AS, but I believe that the previous gap carrying value also may not give you the complete right picture, in which case you have the fair value choice. So neither AS nor Ind AS, I go with fair value. Remember, if you take fair value, that does not mean you're changing an accounting policy or you're necessarily going to revaluation model. It is just a transition base. We do not call it as a change in policy. It is just an opening balance that you are taking. After that, you can decide whichever policy you want to. However, for the point of transition, instead of retrospectively restating, you are given a deemed cost choice of either taking fair value or previous gap carrying value for all of these items. Okay, next is one of the most important point, which is compound financial instruments. This is the institute's darling, and this is one of the very few places where you have also received a question in the main exams. So if there's a compound financial instrument under previous gap, I would have recorded it as per AS principles only, where I would have shown the entire convertible debenture as a liability. If there was a premium on redemption, I would have probably spread that premium over the number of years, but I would not have split between liability and equity component. But when you look at Ind AS, it is mandatory to split between liability and equity component. So if, let us say, the date of transition is 2017, there was a convertible bond, let us say, which was issued in 2015 for 5 years, then 2 years have gone by, 3 years are remaining. What do we do with this? Well, you will have to retrospectively restate as per Ind AS, which means that you will try to find the liability component as well as the equity component on the date of issue. That is step number 1 on 1st April 15 as if Ind AS was applicable. So you will try to find the liability and equity component on 1st April 15. Then you will slowly take the balance till the date of transition. So equity component remains the same, but the liability component will change due to the amortized cost principles. You try to find the liability component on 1st April 17, that is the transition date. Now, this should be the balances which should be appearing on 1st April 17. Instead, what is the balance appearing? So, you, as the third step, you will try to find the previous gap carrying value. You will say, as per previous gap, what is the ledger balance of the convertible debenture? And then, at the last step, you will de-recognize the previous gap carrying balance. So, convertible debenture account debit, whatever is the balance as per previous gap, to liability component, to equity component as per Ind AS, and the balancing figure, if any, will be adjusted to retained earnings. So, remember, generally, unless given otherwise, a balancing figure at the point of transition is not taken into the statement of P&L. It will be adjusted against retained earnings in certain cases. We will study sums for that as well. You might take it to revaluation reserve or fair value reserve, but in most cases, you will take it against the retained earnings. Okay, so we will do an important question for this aspect in some time. Okay, next you have the transition at the stage of business combination. So over here, a very interesting thing happens where the business combination earlier for, let us say, amalgamation absorption must have been done as per AS 14, or in case of parent subsidiary must have been recorded as per AS 21. The principles were different as compared to Ind AS 103, and as a result, the standard says that you can either restate as per Ind AS or you can adopt the previous gap carrying value. But when you are restating as per Ind AS, they give you a very special choice that you can restate with effect from a particular date. So for example, I've done 3 combinations, one in 1990, one in 2005, one in 2015, and now I'm transitioning in 2017. Now I want to restate the 2005 business combination, but I don't want to touch the 1990 business combination. So I can say that, okay, I will retrospectively restate past business combinations with effect from 2005. So my 1990 business combination will continue at the previous gap carrying value. But now if I decide to restate from 2005, every business combination after 2005, let us say one is done in 2015. So even those business combinations which are done in 2015 will need to be restated. And as a result, you will have to restate all business combinations with effect from a particular date. But if you are lazy enough, you say, no, I don't want to do any of that, you are also allowed to take the previous gap carrying value, where you can either take the no restatement choice for past business combinations or restate with effect from a particular date. But if you decide to restate from a particular date, every business combination beyond that date will have to be restated as per the Ind AS principles. Now there is one exception to the no restatement of past business combination aspect, now for which institute has an RTP sum as well, that you may decide not to restate past business combination. That means the goodwill, the minority interest as per previous gap, you will continue, no problem in that. However, you will have to test that goodwill for impairment as on the transition date, and in case there were certain assets like mineral rights, customer relationships, which should have been recorded but were not recorded in the previous gap, then they must be hidden, subsumed within goodwill. So you will have to separate out from goodwill. So let us say you recorded goodwill as per previous gap at 500 rupees. Net assets taken over were 1500, purchase consideration was 2000, so goodwill was 500. But these net assets did not include, let us say, some mineral rights of 300 rupees. So over here your goodwill is 500, but that 500 includes 300 of mineral rights, which should be recorded as per Ind AS, for example. Then on the transition, you will say that, okay, the goodwill is 500, out of which 300 is attributable to mineral rights, which we will show separately, and hence as per previous gap, the other goodwill is 200. I don't need to adjust that. But that is one exception, not very important again from an exam perspective, but an RTP, I think May 2023 question was pertaining to that, though in the main exam institute does not go too much into those aspects. Okay, so this is the choice regarding business combination. So what you decide at the stage of business combination has a spillover effect, for example, for other items like minorities interest. Now as per AS, if you remember, a minority interest would be restricted to zero balance. It will not become negative. However, under Ind AS, because it is a part of equity, you are even allowed to show a debit balance within the non-controlling interest. So if my minorities, if there was huge losses in the past as per AS, my minorities would still be at zero, not negative. Now I want to restate my minorities interest as per Ind AS. Can I do that? Well, there is no separate choice per se. Your decision to restate or not is squarely dependent on what you decided for business combination. So if you decided to restate past business combination, then your minorities have to be restated. Well, I don't have a choice, because if I restate past business combination, minorities or NCI, which is an outcome of a business combination transaction, has to be restated. But if I decide to follow previous gap carrying value for my past business combinations, then my minorities will not be restated. Acha, on the transition date, I will keep the minorities as per Ind AS. Going forward, I will not possibly change. However, on the date of transition, I will have to take the balance as per Ind AS, as per the previous gap. Later, I can follow the Ind AS principles. So long story short, when you look at non-controlling interest, the choice of NCI exactly depends on the choice of a business combination. So if you decide to restate past business combination, then NCI will be restated. If you decide not to restate past business combination, NCI will continue at the previous gap carrying value only, and going forward, Ind AS principles will be applicable. Okay. Next, we have investment in joint venture. Now, as per the previous gap in AS, even if there was a joint venture where there was a separate entity, as per AS 27, you had to follow proportionate consolidation. That is, proportionate assets and liabilities would have been consolidated. But under Ind AS 28, for joint ventures, equity method is to be followed. So let us say you had a company and there was a joint venture, for that joint venture, you would have proportionately consolidated the assets and liabilities as per previous gap. A day later, once you move to Ind AS, those proportionate assets and liabilities could not continue to remain consolidated, and hence they need to be derecognized. But then instead of those, you need to bring in investments. So at what value should you bring in the investment? So the standard says you will bring in the investment at the proportionate carrying value of the net assets derecognized. So if you had a PP, building, machinery, etc., totaling up to 100, your share was 50%, in which case 50 rupees would have been shown along with the individual net assets. So you will derecognize those assets and instead bring in the investment at 50. So your net assets would be derecognized line by line, and investment will be recorded, let us say, at that proportionate carrying value. While doing so, you should ensure that the investment which is recorded should be tested for impairment. So over here, you will ensure that the value of the initial investment would be the aggregate carrying value of all assets and liabilities which are attributable to the joint venture, which can also include a proportionate goodwill if an appropriate ratio is available. Next, you have transition adjustments for government loans as well as for financial instruments. So when you look at, let us say, a government loan, the standard says if these are loans at below market rate. So let us say there is a 5-year loan of 100 rupees that the government has given you, and that is at 0% interest. A market rate of interest on similar loan would have been 10%. In which case, ideally the fair value as per Ind AS would be 62.1 approximately, and the remaining 37.9 will be taken as a hidden grant. However, AS did not have any such provisions, and hence as per previous gap, you must have shown the loan at entire 100 rupees only. Now, once you transition to Ind AS, you have two choices. You can either retrospectively apply the treatment as per Ind AS, that is, you can go back to the date of issue of the loan, find the fair value of the loan and the grant element, and later do amortized cost working or amortize the deferred grant as the case may be as per Ind AS, and find the balance as on the transition date. You can do that provided you have enough data to find the balance of the loan as on the date of issue. However, if you do not have enough data to find the balance of the loan as on the date of issue, then the standard allows you to take the previous gap carrying value, where they say forget it. If you don't have enough data to split, then you can take the previous gap carrying value. Previous gap carrying value, that is 100 rupees as loan, and continue it as it is. So over here, for loans at below market rate, you can either take the prospective application, that is a previous gap carrying value, or a retrospective application provided data is available. Now, this you need to contrast with loans, whether loan taken or loan given as a financial instrument from parties other than the government. So let us say if there is a loan, then as per Ind AS, that loan usually is to be recorded using amortized cost principles. However, as per previous gap, there was no amortized cost principle, and hence if there is a loan other than from the government, then that loan will be shown either at the retrospectively restated balance as per Ind AS, so you can retrospectively restate, or fair value. So this is where a student gets kind of a little confused, in which case what we have tried to summarize, that let us say if there's a loan liability. If it is a loan liability from the government at below market rate of interest, then the two choices are retrospective restatement or previous gap carrying value. But if it is from a party other than the government, then the two choices are retrospective restatement or fair value. So you can take fair value. The previous gap carrying value choice is not available in such cases. Okay. And the last part, which is a relevant part, is linked to estimates. So over here, you might have made estimates as per previous gap, and these estimates would reflect the conditions, position, etc. as per the previous gap. Like you thought on the transition date, let's say 1st April 2017, that the bad debts would be 70,000, and you created a provision for bad debts at 70,000. Now you are in the year maybe 18-19, that is your first Ind AS financial statements. When the transition date is 1st April 17, you could actually see that your actual bad debts were 90,000. However, you could not have foreseen that on 1st April 2017. So your estimate of 70,000 was accurately done as per AS or previous gap. Now you have the benefit of hindsight, whereby you can say that, well, you know what, the actual bad debts were 90,000. However, that you could have known, that you could not have known even if Ind AS was applicable on 1st April 17. So the long story short over here is, if there are estimates that you have taken, and these estimates are taken as per, let us say, previous gap, unless there is an error in those estimates, you will continue the same estimates. You will not take the benefit of hindsight and restate those estimates. Your bad debts provision will still be at 70,000 even as per Ind AS. The additional 20,000 of bad debts will be recorded over the course of the years when the bad debt happened. However, you will not restate your estimate because there was no error. Even if Ind AS okay, you can restate provided there was an error or Ind AS requires a different base. Like for example, you created a provision for warranty. As per previous gap, you thought that there will be a 70,000 repair cost, and that provision for warranty need not be discounted as per AS, but Ind AS required discounting, in which case you can do adjustments for discounting, etc., but you cannot take the benefit of hindsight and restate your estimates. So in summary, we will retain the previous gap estimates unless there is an evidence of an error. We will not use the benefit of hindsight while determining estimates. So these are few important transitionary items which you can use for the purpose of Ind AS 101. So if you kind of probably spend less than half an hour understanding this basic theory, it should suffice. There are a few important questions. If we can kind of go through those questions over here, we will discuss. There are three important questions over here. One of them is a very comprehensive question. The entire question in the same form, question 2 over here will not come, but the adjustments over here are fairly interesting and they can come as a part of a smaller question. Question 1 is a question which is similar to what has already come in the exam. So let us get started with these questions. So we have question number 1. On 1st April 2011, Sigma issued 30,000 6% convertible debentures of a face value 100 rupees each. So that is 30,000 into 100. Let us say the issue proceeds are 30 lakhs at par. The debentures are redeemable at a premium of 10%. So 30 lakhs plus 10%, that comes to 33 lakhs on 31st March 15. So that is after 4 years from 1st April 11. Or they may be converted into ordinary shares at the option of the holder. So this is basically an optionally convertible debenture where the holder has a choice to convert. The interest rate for equivalent debentures without conversion rate should have been 10%, and the date of transition is 1st April 2013. So these bonds which are going to be converted / redeemed on 31st March 15 must be outstanding on the transition date, that is 1st April 13. From the date of issue, 2 years have passed by. Suggest how should Sigma account for the compound financial instrument on the date of transition. The present value factors are given below. So you have the 6% and 10% factor. So what do you need to do over here? Basically there are 4 steps. First, on the date of issue, that is 1st April 2011, you will try to find the liability as well as the equity component as on the date of issue as per Ind AS. So over here, if you look at the liability component, you will take the present value of future cash flows, 30 lakhs into 6%, that is equal to 1,80,000 of coupon. You are under an obligation to pay that for a period of 4 years. So the total annuity factor over here comes to around 3.17. So this is into 3.17 plus, because it's an optionally convertible instrument, there is an obligation to deliver cash if the holder demands, and that is 33 lakhs with a 10% premium. So this is plus 33 lakhs into the discounting factor, let us say of 0.68. So if you multiply this, I guess your answer comes to around 28 lakh 14,600. Remember, this balance is the balance as on 1st April 2011. You are transitioning on 1st April 2013. The remaining will be equity component. You have received 30 lakhs of cash, out of which you are believing 28 lakh 14,600 is attributable to liability. So your remaining 1,85,400 will be attributable to equity. As per 109, equity component does not change, but the liability component does, and hence you will prepare an amortization table where you will have year 1 and 2, the opening balance of around 28.14 lakhs. Your effective interest will be at the rate of 10%, and every year you will pay a coupon payment of around 1.8 lakhs. You will get some closing, and if you keep on doing this for around 2 years, you will get around 30,27,666. Now this will give you your liability component as on the date of transition. One needs to remember that the equity component continues to remain the same. There would be no change in the equity component. So ideally, as a second step, on 1st April 2013, you will find that the liability component comes to around 30,27,666, whereas the equity component continues to remain 1,85,400. Now this is as per Ind AS. Now if you go to the previous gap, as per previous gap, you never bothered to split between liability and equity. You showed 30 lakhs as your convertible debenture, but you know that after 4 years you have to possibly redeem at a 3 lakh premium, and hence plus 3 lakhs into, let us say, 2 by 4, and hence this comes to around 31,50,000. So this is your balance as per previous gap. Now one can always argue that as per previous gap, do I need to amortize premium? If yes, how do I amortize? Well, as per ICI, the latest solution in the study material, this is what is done, and I don't see any error over here. So you will amortize the premium over the life like you do for a zero coupon bond, and thereby arrive at around 31,50,000. Now this must be the balance as per previous gap. So basically I need to record 31 lakh, I need to derecognize 31,50,000 and instead record 30,27,666 and 1,85,400. So I will pass a derecognition entry whereby I will debit the convertible debentures by 31,50,000, credit the liability component by 30,27,666 and equity component by 1,85,400. Now by doing so, your entries may not necessarily tally, and hence there will be a balancing figure, and that balancing figure will be adjusted against retained earnings. So if I go to see, your adjusting entry would be convertible debentures debit, liability component credit, equity component credit, and the balancing figure goes against retained earnings. The logic of taking this against retained earnings would be that under the previous gap, that is AS, you must have booked an expense of 1,80,000 for coupon and 75,000 as amortization each year for a period of 2 years. So that is around 2,55,000 and 2,55,000, that is around 5,10,000 of expense over 2 years. But under Ind AS, your expense would be 2,81,000 and 2,91,000. Basically your expense as per Ind AS would be around 5,73,000 approximately, and hence the 63,000 of expense which was not booked under previous gap is now getting booked. It is not booked earlier, and hence the adjustment is done against the retained earnings. We have tried to explain that over here in a fairly brief way. Now just a background and some history behind this question. If you were to open this similar question which was there in the November 18 suggested answers or the RTP of May 2020, you will see a slightly different solution which is erroneous. Institute has correctly rectified it in the subsequent years, and the new study material that we speak now has the rectified solution, and hence you will stick to the study material solution irrespective of if and when you were to open the older RTPs or suggested answers. You can safely ignore the solution over there. The solution that we have solved currently is in line with the latest institute material, which is logical and correct as well. Okay, next is question number 2. If you have done question number 2 earlier, nothing like it, but if not, I would strongly recommend that you pause the video, read through the question number 2 from the Super 99 file. It is a fairly detailed question for schedule 3 as well as Ind AS 101. A lot of adjustments get covered, and then we will tackle one adjustment as it comes. Okay, so we will go to question number 2. Shaurya is a company which is registered in New Delhi. 60% of Shaurya's shares are held by the government of India and rest by other investors. Not relevant. It's the first time that Shaurya would be applying Ind AS for the preparation of the financials for the year 1920. So 1920 is the first Ind AS financial statement. So the transition date will be the first day of the earliest year. So that is 1st April 18. Following balance sheet is prepared as per earlier gap, that is AS, at the beginning of the preceding year along with the additional information. So you have been given the 31st March balance sheet as per AS, and as you can rightly see that the balance sheet starts with the shareholders fund section, which is a typical AS balance sheet, whereas the Ind AS balance sheet starts with the assets. So you have the entire balance sheet and then some additional information. So from point 1 to point 4 or 5 over here will be the information if you have read regarding the schedule 3 application on whether schedule 3 has been correctly applied or not, and then everything else is pertaining to an Ind AS 101 application. So we will just review each of them. Additional information, everything is in 1000. Other current liabilities include 3,90,000 of liabilities that are to be paid in cash, such as expenses payable, salary payable, and 60,000 as statutory government dues. So out of the other current liabilities, if you see of 4,50,000, we can say that 3.9 lakhs or 3,90,000 is going to be other financial liabilities, whereas the remaining 0.6 will be either other current liabilities or in short-term provisions if it is payable to the government in terms of a provision item. So this is just a schedule 3 breakup in terms of financial items. Next, we have long-term loans and advances include 40,000 as loan, and remaining amount consists of advance to staff. So if you go to long-term loans and advances, again in the asset section, you will see out of 1,50,000, let us say 40,000 which is loan, and the remaining 1,10,000 which is advance to staff. So advance to staff has two alternative treatments. Remember, long-term loans are financial assets. However, advance to staff, if the staff is intending to pay it back through service, it is not a financial asset. If it is intending to paying back through cash, it is a financial asset. Either of the assumption can be used and you can solve accordingly. Third is other non-current assets, consist of 2 lakh as capital advance to suppliers. If it is capital advance to suppliers, which means the suppliers over here will give you an asset in return of the advance, and hence this is not a financial asset, should be a part of other non-current assets, and it is a part of other non-current assets, so there would be no change for the capital advances over here. Then point 4, other current assets include 3,50,000 of assets receivable in cash and prepaid expenses of 50,000. So if you look at other current assets, out of this 3.5 lakhs will be other financial assets because you have a contractual right to receive cash, whereas 50,000 as prepaid expenses will be other current assets. That is fine. This is going to be other current assets. Okay, short-term provisions include dividend payable of 2 lakhs. The dividend had been a result of board meeting wherein the declaration of dividend for the year was made. However, it is subject to shareholders' approval in the AGM. So, whatever is happening as per previous GAAP under Ind AS till the time the shareholders approve it in the general meeting, it cannot be a liability, and hence dividend payable will have to be reversed. So, your adjusting entry can be dividend payable account debit, which is a part of short-term provisions. To what? Well, you will credit the retained earnings as a part of other equity, and as a result, you will, let us say, reduce your short-term provisions by 2 lakhs. And also increase the reserves and surplus by 2 lakhs in the form of your retained earnings. Okay, the CFO of Shaurya has presented the following information against the relevant items in the balance sheet. First, PP consists of a class of assets of office building whose carrying value is 10 lakhs. Fair value of the said buildings as on the date of transition is 15 lakhs. So there is a 5 lakh adjustment. Company wants to follow the revaluation model as its accounting policy in respect of PP for the first Ind AS financial statements. So remember, for PP, the transition can happen by retrospectively restating as per Ind AS or switching to the previous GAAP carrying value or fair value. Now, here fair value is given, and going forward you want to follow the revaluation model, so it is appropriate that you kind of adjust the PP, take it to the fair value. So PP will be debited by 5 lakhs to what? Well, usually the credit goes to retained earnings. However, if going forward, if you are going to follow the revaluation model, then it also makes sense to kind of credit this into the revaluation or fair value reserve. Having said that, you can also take it to retained earnings. Institute over here has taken it to the fair value or the revaluation reserve as the case may be. So if you take it to the revaluation reserve of 5 lakhs. So over here, when you look at the PP, your PP will increase by 5 lakhs, and correspondingly in your reserves, there will also be a revaluation or a fair value reserve to the extent of 5 lakhs. Okay, second, the fair value of intangibles on the date of transition is 2,50,000. However, the management is reluctant to incorporate the changes. Remember, if the management does not want to incorporate the changes, that is also fine. You can take the transition at the previous GAAP carrying value, and hence there would be no adjusting entry. Your intangibles will continue to appear at the 2 lakh number which is there in the balance sheet. Third, Shaurya has acquired 80% in a company called as Excel a few years ago, thereby acquiring control at that time. So that's like a business combination. Shaurya recognizes goodwill as per the erstwhile accounting standards. So if you go to see, the goodwill over here is 1 lakh, which is recorded as per the erstwhile standard, maybe AS 21. Accounting the excess of consideration paid over the net assets acquired at the date of acquisition. Fair value exercise was not done at the time of acquisition. So ideally, if you were to retrospectively restate as per Ind AS 103, you will have to take over and calculate the goodwill based on the fair value of the net assets as on the date of acquisition. The problem over here is, if you want to retrospectively restate past business combinations, you need the fair value as on the date of acquisition, which is not available. In which case, what will we do? Well, we will take the choice of not restating past business combinations and thereby continuing at the previous GAAP carrying values, due to which you will not change the goodwill or any other number. For each of these, you will have to give explanations on why you are adopting the previous GAAP carrying value. That is, you are taking the choice which is available for not restating past business combination because the fair value exercise was not done, and hence application of Ind AS 103 retrospectively would be difficult or probably not possible. Next, you have trade receivables amounting to 20,000 as provision for bad debts measured in accordance with the previous GAAP. Okay, so provision for bad debts should be reduced from debtors, nothing wrong in that. As per the latest estimates using hindsight, the provision needs to be revised to 25,000. Should you revise it at the transition date? The answer is no. There will be no revision. You will continue with the previous GAAP values because the estimates were correctly done as per the previous GAAP. Even if Ind AS was applicable, you would still have estimated it to be 20,000. The change of 25,000, that is 5,000, is arising due to hindsight, and hence there will be no effect on the transition date. No change. The company has given a loan of 1 lakh to an entity for 10 years, 6 years ago. So 4 years are remaining. Transaction costs were incurred separately for this loan, and the loan carries an interest of 7%. The principal amount is to be repaid in equal installments over 10 years. So 10,000 each year. Interest is also payable at the end of each year, and the fair value of the loan as on the date of transition is 50,000 against the carrying value, which is 40,000. Remember, initially in the second subpoint we had said that long-term loans and advances include loans of 40,000. This must be the 40,000, that is 1 lakh of loan, out of which 60,000 is repaid and thereby 40,000 is still remaining. However, Ind AS 109 mandates to recognize interest income as per effective interest method after the adjustment of transaction cost. Management says it's a tedious task given in the given case to apply effective interest with retrospective effect and hence is reluctant to apply the same. So basically, for financial instruments like loans given, you have two choices. You can either retrospectively restate, which the management feels is tedious, or you can shift to fair value. Remember, the previous gap carrying value choice is not available over here and hence the loan will be debited, let us say by 10,000 with the corresponding credit going against retained earnings to 10,000. So over here, when I go to see the loan over here, 40,000 plus 10,000, so the loan becomes 50,000 and the second effect goes against the retained earnings, which is another 10,000 which will be added over here. Okay, next you go to point F in long-term borrowings. So borrowings means it's a financial liability. 4,50,000 is component due towards the state government. So this is loan taken from the state government. Interest is payable at 4%. However, the prevailing market rate is 8%. Okay. Now one can always argue that if the market rate is available, this is loan at off market and hence you can find the hidden deferred grant. However, as per Ind AS 101, you can retrospectively restate, that is you need the data for the market rate when the loan was actually taken. 8% is the rate today, that is on the date of transition. You need the rate when the loan was taken, which probably is not available, and as a result, you cannot retrospectively restate. The second option over here is if you don't retrospectively restate, the standard says you can continue with the previous gap carrying value. The fair value choice is not available for loans taken from the government at the concessional rate. So fair value of the loan stands at 4,20,000. You have to consciously ensure that you ignore this fair value adjustment and continue with the previous gap carrying value because retrospective restatement for this loan balance is not possible. Next, under previous gap, the mutual funds were measured at cost or market value, whichever is lower. Under Ind AS, the company has designated these investments at fair value through profit and loss. Okay. But previous gap, they were shown at cost or market value. Under Ind AS, they have to be taken at FATPL, so you have to change it at fair value. The value of mutual funds as per previous gap is 2 lakhs included in current investment. However, fair value is 2,30,000. In which case, you will record the investments at 2,30,000. So investment account debit by 30,000. To let us say retained earnings again, FVTPL. So at the stage of transition, you will adjust the retained earnings. So in your current investments, you will increase by 30,000. And the second effect again for this will go against the retained earnings, which will increase by another 30,000. Okay, ignore separate calculation for deferred tax. Thank you. Assume the net deferred tax income to be 50,000 on account of transition adjustments. So this is deferred tax income. So deferred tax income is created at the stage of deferred tax asset. So DTA account debit. Typically you take it to the profit and loss account. However, this is arising out of transition and transition adjustments are going to retained earnings. So over here, this will also be adjusted through the retained earnings. So DTA, you don't have a deferred tax asset, but you have a deferred tax liability. So from that you will subtract 50,000 and the corresponding effect will go against retained earnings. So you will credit it against the retained earnings. So thereby you have considered everything, prepare transition date balance sheet in as per Ind AS and the necessary explanation for each items. So if you have considered all of this, your transition date balance sheet will comprise of share capital at 10 lakhs, devaluation reserve of 5 lakhs and then a retained earnings. You will have 25 and 2, 27, 2710, 2740 and probably 2790, 27.9 and 5 will come to, let us say, just a second, this is what, 40, perfect. So this is 27.9 plus 5, that is 32.9 coming within other equity. Within borrowings, provisions, there is no change. Your deferred tax will come to around 3 lakhs. Trade payables remains the same. Other financial liability at 3.9, other current liability at 60,000 and short-term provisions at 10 lakhs. PP comes at 25 lakhs, intangible same, goodwill same, non-current investment same. Within long-term loans will be at 50,000, advances at 1,10,000, other non-current assets still at 2 lakhs and current investments will be at 18,30,000, inventories at 12,50,000, no change for trade receivables, cash and then other financial assets at 3,50,000 and other current assets for prepaid at 50,000. Praying to God, your balance sheet should ideally tally at around 90,40,000. So fairly detailed and an interesting question where a lot of transitionary adjustments do get covered and your ability to pick up the right transition base like fair value, previous gap carrying value or deciding not to make any adjustments is quite important over here. So that is question number 2. Next, we have another question which was there in the MTB, which is similar to a GFRS question, but it gives you a decent enough insight into the transition adjustment for PP. So over here, there are two subparts. One is for site restoration and another is for PP. So let us review that. G operates oil exploration and production facilities. It is preparing transition date opening balance sheet as per Ind AS. Okay, we'll first look at the second subpart. G has 4 assets, each in different classes of property, plant and equipment. Asset 1 and 2 are revalued as per previous GAAP. So you were following the revaluation model. Assets 3 and 4 are not. So you were following the cost model probably. Under previous GAAP on 31st March 11, immediately prior to the transition, the extract is as follows. So you have for 1 and 2, the net book value and the revaluation surplus that is appearing. For 3 and 4, because cost model was followed, there is no need to show there is no revaluation balance. On adoption of Ind AS, the management decides that under Ind AS it will. So for each of the assets, it is doing a different thing. Continue to revalue asset 1. So basically, you are following the revaluation model earlier. You are continuing to follow revaluation model, and hence there will be no change in the balance in the revaluation surplus. It will continue at 2,500 because you are intending to follow revaluation model going forward. So there is no need to adjust the revaluation surplus. Secondly, the fair value of asset 1 at the date of transition is not materially different from the carrying value under previous GAAP, in which case you can take the transition based on the fair value or even the previous GAAP carrying value. So over here, for asset 1, you can transition at the previous GAAP carrying value because it is not materially different from the fair value, and thereby post the transition, your asset will appear at 4,000. Your evaluation surplus will continue to appear at 2,500, and there will be no adjusting entry because of asset 1. Next, you go to asset 2. Under previous valuation of asset 2, use the previous valuation of asset 2 as deemed cost. So you are taking the previous GAAP carrying value as told, and adopt a policy of costless depreciation under Ind AS. So if you are following the previous GAAP carrying value, that means 1,500 will continue to appear as the transition base. No adjustment for PP. However, since going forward you want to follow the costless depreciation as the base, then this revaluation has to be removed, and hence an adjusting entry will be passed to remove the revaluation and credit the retained earnings. So it's a non-reclassifiable OCI, will go against the retained earnings. So thereby, for the second asset, if you go to C, you will have no revaluation balance and an entry to adjust the revaluation surplus to the retained earnings, because going forward you are going to follow the cost model, whereas in asset 1 you are going to continue with the revaluation model, and hence you did not do any adjustments. Okay, third, adopt a policy of revaluation for asset 3. Earlier you were following the cost model. Now you are moving to the revaluation model. The fair value of asset 3 at the entity's date of transition is 5,000. So if you transition using fair value as a transition base, because you are going to follow the revaluation model, then your PP will increase, let us say, by 3,000. Now the question is, where should the credit go? Well, usually if going forward you are going to follow the cost model, then the credit can be taken to retained earnings. But if you are following the revaluation model, then might as well you take the balance to the revaluation surplus of 3,000. So if you look at asset 3, then post transition, the asset 3 will appear at 5,000 and 3,000 will appear in the revaluation surplus. Okay, as you can see over here, 5,000 and 3,000 will appear in the revaluation surplus. Okay, and the last asset, asset number 4, continue to use a policy of cost as depreciation for asset 4. So if you want to continue with the cost as depreciation, then might as well you transition at the previous GAAP carrying value. In any case, you are at 2,800, you will remain at 2,800. There will be no change in any other balance, so there will be no adjusting entry. All depreciation methods are already in accordance with the required Ind AS 16. Discuss the treatment under Ind AS of valuation of 1, 2, 3, 4 being a part of PP. So basically for asset 1, you continue with the previous GAAP carrying value. You will also continue with the revaluation balance. For asset 2, you will continue showing this at the previous GAAP carrying value of 1,500, but since you are following the cost model going forward, you will reverse the revaluation balance, take it to retained earnings. For asset 3, you are following the cost model, you want to follow the revaluation model, transition happens at fair value, 3,000 is adjusted against PP with a corresponding credit to revaluation. And for the last asset, you were following cost model, you continue to follow cost model, transition happens at the previous GAAP carrying value, no further adjustments or changes. Okay, that is for your sub point 2, giving you a very good insight on when to adjust revaluation, retained earnings, previous GAAP carrying values, fair values, etc. And then is sub point 1, which is a kind of a theory point where they are asking you that what will happen in case there was a decommissioning liability which was not recorded under previous GAAP. Remember, there is no separate transition base for provision for site restoration, and hence you will have to retrospectively restate. So there is a significant decommissioning obligation in connection with several oil wells, but as per previous GAAP, we did not require the obligation to be recognized. Well, so what? Under Ind AS, you will have to recognize it. So for example, the date of transition is 2017. The site restoration was created in 2015 for a period of 10 years. Previous gap, you did not do anything. Then you will go back to 2015, try to figure out what will be the site restoration obligation. Then do unwinding for the next 2 years and arrive at the site restoration balance as per Ind AS as on the date of transition. You will credit the site restoration balance. Now the question is, what will you debit? Well, if you decide to retrospectively reset the PP, then you will also find the PPE balance including the site restoration and arrive at the PPE balance. We have even included a numerical example for an understanding over here, but you can either decide to retrospectively restate the PP, in which case you will reset the PP as per Ind AS, create the site restoration provision, and if there's a balancing figure, take it to retained earnings. But the most common thing is you will take the deemed cost for PP, in which case let us say you take the previous gap carrying value, in which case the PP as per previous gap will continue, but you will still have to create a provision for site restoration, in which case you credit the provision for site restoration and the corresponding debit goes against the retained earnings. So broadly, this is pertaining to the important questions from an Ind AS 101 perspective, where you kind of tackle individual items like compound financial instruments in question 1, or PP in question number 3 sub point 2, or a generic master question like question number 2. So this hopefully will help you cool down your nerves a little for Ind AS 101. I hope this session has been helpful to you. Please do show some love and press the like button and subscribe if you want more updates. Hopefully the videos will be helpful. We will come up with more videos. Till that time, good luck, goodbye, and keep studying. See you soon.